A hedge fund staffed by two Nobel Prize winners and some of the most sophisticated financial minds in the world nearly collapsed the entire global financial system in 1998, using math that was, by most technical measures, correct. The firm was Long-Term Capital Management. Founded in 1994 by a group that included legendary bond trader John Meriwether, along with economists Myron Scholes and Robert Merton, who would go on to share a Nobel Prize in Economic Sciences in 1997, partly for work underlying the very trading strategies their fund employed. LTCM's approach was built on incredibly sophisticated mathematical models designed to identify tiny, temporary pricing inefficiencies between related financial instruments, bonds that should theoretically trade at nearly identical prices but occasionally drifted slightly apart due to short-term market friction. The fund would bet that these tiny gaps would eventually close, capturing a small profit each time. The problem was that these individual price gaps were so small that meaningful profit required enormous scale and, crucially, enormous leverage, borrowing vast sums of money to amplify what would otherwise be a tiny, unremarkable return into something genuinely lucrative. At its peak, LTCM controlled positions worth over $1 trillion, built on a base of only a few $billion in actual capital. Morgan Housel has written that financial models built on historical data can be extraordinarily precise about the past while remaining almost completely blind to the specific, unprecedented way the future eventually decides to misbehave. LTCM's models were built on decades of historical market relationships. What they hadn't accounted for was a scenario where multiple unrelated markets around the world would panic simultaneously, for reasons the models hadn't been designed to anticipate. In 1998, Russia unexpectedly defaulted on its government debt, triggering a global panic that spread rapidly across markets LTCM's models had assumed were only loosely connected. Investors around the world rushed towards safety at the same time, causing exactly the kind of correlated, simultaneous market movement that LTCM strategies depended on never happening. The tiny pricing gaps the fund had bet would close instead widened dramatically, and because the fund was so heavily leveraged, even a relatively modest adverse move translated into catastrophic losses. Benjamin Graham's investment philosophy emphasized a margin of safety, building enough of a buffer into any investment that even being partially wrong wouldn't lead to disaster. LTCM's entire strategy operated with almost the opposite assumption. Extreme leverage meant there was essentially no margin of safety at all if the underlying models turned out to be wrong about even one significant scenario, and in 1998, they were. Daniel Kahneman's research into overconfidence explains part of why some of the smartest people in finance built a strategy this fragile in the first place. The fund's founders had genuine, world-class expertise, and that expertise appears to have created a dangerous confidence that their models had accounted for essentially every meaningful risk. The presence of Nobel laureates on the team didn't prevent the collapse. If anything, their reputations may have made outside observers, and perhaps the fund's own leadership, less likely to question the fund's extreme leverage. As LTCM's losses mounted through the summer of 1998, the fund's exposure was so enormous, and so deeply interconnected with major banks around the world through complex trading relationships, that its potential collapse threatened to trigger a much broader financial crisis. In September 1998, the Federal Reserve organized a private bailout, coordinating a group of major banks to inject enough capital to unwind LTCM's positions in an orderly way, specifically to prevent the kind of chaotic, uncontrolled collapse that could have spread into the broader financial system. Robert Kiyosaki's core lesson about understanding exactly what risk an asset actually carries applies here at an institutional scale. LTCM's investors, and in some ways its own leadership, appear to have mistaken sophisticated mathematics for genuine safety. The models were technically impressive. What they couldn't do was account for a kind of risk that doesn't show up cleanly in historical data, the risk that everyone, everywhere, panics about unrelated things at exactly the same moment. Here's an honest complication worth including, since LTCM's story is sometimes oversimplified into a tale of simple greed or incompetence. The fund's core trading strategies, in isolation, were genuinely sound and mathematically well-reasoned. The failure wasn't really in the underlying logic of individual trades, but in the scale of leverage applied to that logic, and the assumption that markets that had historically behaved independently would continue doing so even during a genuine global panic. George S. Classen's advice about the danger of overextending yourself financially applies here on a scale Classen himself likely never imagined. LTCM's downfall wasn't a story about a bad idea. It was a story about a genuinely intelligent idea pushed to a scale of leverage that turned an ordinary market disruption into an existential threat, both to the fund itself and, briefly, to the broader financial system around it. This isn't a simple story warning against intelligence or sophisticated financial models. LTCM employed genuinely brilliant people using genuinely sophisticated tools. What makes this story worth remembering is the specific gap it exposed, the difference between a strategy being statistically sound under normal conditions, and a strategy being survivable under the specific, rare conditions that eventually determine whether extreme leverage destroys everything built on top of it. So here's a question worth sitting with. In your own financial decisions, is there a strategy you trust simply because it's worked reliably so far, without asking what specific, rare scenario could make all of that history irrelevant at once? Before you leave, I want to hear from you. Have you ever trusted a system, a plan, or a strategy simply because it had worked consistently for a long time, right up until the moment it suddenly didn't? Read a few comments before you go. Some of the most sobering stories on this channel come from people who've experienced exactly that kind of sudden, unexpected failure themselves. Next week, I'll pick one comment and send its author one of the books that inspired this channel. And if these stories help you think differently about money, you'll find a way to support future research in the description. Every contribution helps buy books, access research, and keep this content free for everyone. Remember this. Long-term capital management didn't collapse because its math was wrong. It collapsed because even correct math offers no protection against the one scenario nobody built it to survive.